all-weather portfolio is modeled after the all-weather fund, created by famous investor, hedge fund manager, and billionaire Ray Dalio, who is the founder of the world's biggest hedge fund firm, Bridgewater Associates. Ray Dalio is a well-respected investor, and his theory behind the all-weather portfolio is to build a portfolio that will survive the inevitable changing weather of economic cycles, whether that's a recession, rising inflation, deflation, and everything else in between. It's designed to maximize diversification by investing in different asset classes. For example, when stock prices rise, then typically what tends to happen is bond prices drop, and vice versa. When stocks are down, bond prices usually go up. So by investing in sectors that are uncorrelated, your portfolio will be more susceptible to economic cycles. So what asset classes actually make up the all-weather portfolio? The portfolio is made up with 40% in long-term bonds, 30% in US stocks, 15% in short-term bonds, 7.5% in commodities, and the other 7.5% is allocated to the beautiful precious metal that we call gold. Now, Ray Dalio explains that each of these asset classes deal with changing economic cycles differently. You have inflation, deflation, rising economic growth, and declining economic growth. Based on these four economic cycles, or as Ray Dalio puts it, the four seasons of the economy, this portfolio is designed to withstand the good times and the bad. Most people view this portfolio as a medium risk portfolio, and over the last 10 years it has obtained a 7.5% compound annual return with a 6% deviation, meaning its ups and downs, which I will discuss in more detail shortly. The dividend yield over the last 10 years has averaged around 1.5 to 2%, which isn't the best yield, but it's still better than having your money sitting in a bank account losing its purchasing power. Now, if you wanted to recreate this portfolio for yourself, you can do that by investing in different ETFs that match the asset classes in the portfolio, which I will now explain in detail. So if you know anything about ETFs, then you have probably heard of Vanguard and iShares, which are the two heavyweights in the ETF world. So let's recreate the all-weather portfolio using ETFs that are available across these two platforms, and how you can achieve the same results as Ray Dalio by allocating your money into these exchange-traded funds. So starting off with the biggest position inside the all-weather portfolio, which is 40% invested into long-term bonds, the iShares 20-year plus Treasury Bond ETF, ticker symbol TLT, is a good option that fits the criteria for the all-weather portfolio. Now, as the name of this ETF implies, the majority of the fund's capital is allocated to US long-term bonds, and the objective of this ETF, as stated in the iShares website, seeks to track the investment results of an index composed of US Treasury bonds with remaining maturities greater than 20 years. In the last 10 years, the iShares TLT ETF saw a compound annual return of 4.5% with a 12% standard deviation, and in the last 25 years it saw a compound annual return of 7% with a 11.9% standard deviation. In 2021, they distributed a 1.4% dividend yield. The second biggest position in the portfolio allocates 30% to US stocks. A good ETF that meets the criteria is the Vanguard Total Stock Market ETF, ticker symbol VTI. The objective of this fund seeks to track the performance of the CRSP US Total Market Index, meaning the fund allocates its money according to that index, which is made up of a variety of large cap, mid cap, and small capitalization equities diversified across both growth and value stocks. Over the last 10 years, this ETF obtained a 6.29% compound annual return with a 13.44% standard deviation. And over the last 25 years, it saw a 9.8% compound annual return with a 15.7% standard deviation. In 2021, this ETF distributed a 1.5% dividend yield. The third biggest position is 15% allocated to short-term US bonds. The iShares 3 to 7 year Treasury Bond ETF with the ticker symbol IEI is a good example that can be used. It's self-explanatory in its objectives, as it seeks to track the investment results of an index composed of US Treasury bonds with remaining maturities between 3 and 7 years. Over the last 10 years, this ETF obtained a 1.8% compound annual return with a 2.8% standard deviation. And over the last 25 years, it saw a 4.5% compound annual return with a 4.1% standard deviation. In 2021, this ETF granted a 0.7% dividend yield. And the last two positions is 7.5% allocated to commodities, and the other 7.5% allocated to gold. For a diversified commodity ETF, the iShares S&P GSCI Commodity Index with the ticker symbol GSC is a perfect fit for the all-weather portfolio. In the last 10 years, this ETF saw a 6.3% compound annual return with a 21.6% standard deviation, and in the last 25 years, it saw a 0.6% compound annual return with a 22.2% standard deviation. Now, if you don't already know, commodities are very volatile, which explains the high deviation, and the other 7.5% is allocated to gold. Now, I personally think that the only way one should invest in gold is to buy gold bullion, whether that's gold bars or gold coins. I prefer to have the physical gold rather than investing in gold stocks, which is why I have started collecting gold in the form of jewelry and rare coins. But if gold stocks are something that you would prefer, then the SPDR Gold Trust ETF, ticker symbol GLD, is a popular gold trust that you can invest in. The objectives of the trust is designed to track the price of gold, and in the last 10 years, the GLD Gold Trust ETF saw a 1.1% compound annual return with a 15.1% standard deviation, and in the last 25 years, it saw a 6.3% compound annual return with a 16.3% standard deviation. So that's exactly how you can recreate the all-weather portfolio using the exchange-traded funds just mentioned, and your returns will be on par. But now let's look at what kind of returns you get from a 7.5% compound annual return, which is on par with the all-weather portfolio. If you were to invest $1,000 spread across the ETFs that we just discussed, with the same percentage in each fund to match the all-weather portfolio, without investing another dollar, over 20 years, that $1,000 investment would have grown to $4,461. Now, if you were to make regular deposits of $100 a month, so $25 a week, on top of your $1,000 investment, your investment plus regular deposits of $25 a week or $100 a month would grow to $59,834. And if you kept that up for 30 years, keeping regular deposits of $100 a month, your investment would grow to $144,166. And you would have only deposited $37,000 over 30 years. Now let's go even bigger than that, and if you could afford to deposit $250 per week or $1,000 per month into your portfolio, that investment would be worth $1.4 million after 30 years. Now that's the power of compounding interest. The longer you stay invested, the more the interest compounds, which is why I personally follow the long-term investing approach. For more videos on all things investing, subscribe to this channel.